Let's review the Chapter 18 quiz question 2. The following information is available for the first 3 years of operations for Fabergé Corporation. And we're given the taxable income for 2020, 2021, and 2022. Then we're told on January 2nd, 2020, equipment was purchased for $500,000. The equipment had an estimated service life of 5 years and no residual value. Straight line depreciation is used for book purposes, and CCA at 30% is used for tax purposes. And we're told in brackets, subject to the half-year rule for the first year. Number 3, on January 2nd, 2021, $210,000 was collected in advance for the rental of a building for 3 years. The entire $210,000 was included in taxable income in 2021, but 2/3 of the $210,000 was reported as unearned revenue at December 31st, 2021 for book purposes. And the enacted tax rate is 40% for all years. So the first thing we're asked to do is to prepare a schedule comparing depreciation for book purposes with CCA for tax purposes. So let's get started with that. Let's make sure we're really careful and label what we're doing in the question. So here we're going to have depreciation versus CCA. Okay, and that's what we're doing. So here, let's find a year down here. And the current year is 2020. And how far am I going to run out this schedule? Well, we're told that for accounting purposes, the useful life is 5 years. So let's run it out at least 5 years. So 2020, 2021, 2023, 24. So that's 5 years right there. And I'm actually going to run an extra column just called remainder, and I'll explain that as we go. So then here I'm going to have my depreciation and my net book value. My net book value is going to help me make sure my schedule is working. Here I'm going to have my CCA, and I'm going to have my UCC, which is essentially the net book value for tax purposes, called the undepreciated capital cost. And then here I'm going to have my differences. Okay, so let's start by figuring out what depreciation is. We should know that for accounting purposes. So it says 500,000. So let's just put purchase price 500,000. And for accounting purposes, 5 years, no residual value. So I'm simply going to take the purchase price and I'm going to drag this formula down. So I'm just going to lock it in and I'm going to divide it by 5 years. So that means I'm going to have depreciation of $100,000 per year. And I'm going to drag this down. So that's 5 years of 100,000. Let's check our net book value. So we're going to start with $500,000. We're going to subtract the depreciation each year. So now my net book value is 400,000. In 2021, I'm going to start with my opening net book value and subtract the depreciation that year. And you get down to 300,000. If we drag this down, we should see the net book value at 0 at the end of the 5 years. And I can see that, so I know that these depreciation numbers are correct. Now let's move on to CCA. So for CCA, we're told that this is a 30% asset and that we're going to use the half-year rule for the first year. So to calculate CCA, we're going to start with the same value, the purchase price, and now we're going to apply the rate of 30% to the purchase price. And in the first year, because we're taking the half-year rule, I'm also going to multiply this by 0.5, which is going to take half of what we would normally take. The half-year rule is used to account for assets in the year of acquisition and the year of disposal. It basically evens out the period, so you can assume everything was purchased halfway through the year. So my first year of CCA for tax purposes is going to be 75,000. Now, what is my UCC? So my undepreciated capital cost is going to be the value of the asset minus the CCA that I've taken to date, 75,000. So my UCC is going to be 425,000. Now for CCA, because we're applying a rate against the UCC, it's really important that you remember that we're applying this 30% rate against the UCC, not against the purchase price. So now I'm taking the UCC times 30%, and that's going to be my CCA for 2021. And you can see it's a lot higher because I didn't apply the half-year rule. Now I'm taking the full year. Here I had multiplied it by 0.5, and here I've just got the whole amount. So now my UCC is going to be my opening UCC minusing the CCA I took for that year. So my ending UCC is going to be 297,500. So my next CCA for 2022 is going to be my opening UCC times 30%, 89,250. And then I'm going to calculate my UCC, opening UCC minus the CCA I just took. So now I've got 208 and so on. So we're going to just continue that same pattern and making sure that we're using the UCC as the basis for the 30%. Okay, so what happens at the end of the period? So here, look, you can see that in this year, my net book value for accounting purposes, is 0, but I still have an undepreciated capital cost of the equipment for tax purposes of 102,000. So I've run this column here called remainder. I could run this schedule out like another, 5 years or so until this value is depreciated, but it obviously depreciates a lot slower because now you're only multiplying the 30% times a much lower base. So here I'm just going to plug the remaining CCA to be the same as the UCC because in some point in the future that is going to happen. And then this will give me a remaining UCC of 0. You can see I just plugged these two numbers so that they're the same, meaning that at some point I'm going to take the UCC of the whole amount because what's going to happen is over the term of the asset, the accounting depreciation and the tax depreciation, or the tax CCA, I should say, is going to be the same. We're going to recognize the value of the whole asset either way. I just need to pull this down. So we're going to take 500,000 either way, and it's just a timing difference. That's why this is a temporary difference. So my difference here is going to be my accounting depreciation minus my CCA. So what happens if my accounting depreciation is higher than my CCA for tax purposes? Is that going to lead to a future tax benefit or a future tax liability, deferred tax asset or deferred tax liability? Well, if I've taken more depreciation for accounting and less for tax, it means that in the future I can take more for tax because I still need to catch up to the $500,000 total value. So it means I'm going to have a future tax deduction. Now, if in the next year you can see that now my accounting depreciation is 100,000 and my CCA without the half-year rule is 127,500. So what does that mean? Well, it means that in the future I have that much less I can deduct from tax. I've already deducted 127 and I've only deducted 100,000 from accounting. So now I'm ahead. I've got lower profit for tax. So it's going to even out and I'm going to have to add that back at some point. So that's going to be a future tax liability. Okay, so we'll drag these down and that's going to give me my schedule of differences. And that's all that we're asked for in A. So it simply says prepare a schedule comparing depreciation for book purposes with CCA for tax purposes. And that's exactly what we did here. And we needed this difference column because it does say compare. So number B, or item B, determine the deferred tax asset or liability at the end of 2020. So let's just run a column here. So how do we figure out the deferred tax asset or the deferred tax liability? So deferred tax asset or liability. So what we do here is we're going to run the tax rate. We were told it's 40% for all years. We're going to run that down. And then we're going to have an asset and a liability column. You could run them together because the signs will be different, but I find it much more clear to run them separately. So here we know this is going to be an asset because our depreciation for accounting purposes is higher than our depreciation for tax, meaning that in the future we can take a higher tax deduction times the tax rate. So the difference times the tax rate is going to give me my future tax, my deferred tax asset. And here, conversely, this difference, which is where my tax CCA is higher than my accounting depreciation, meaning that I'm going to have less I can take away from taxes in the future, is going to give me my deferred tax liability. And basically, we just continue running that through. These are all deferred tax assets. They're positive. What did I do there? Okay, and then the last one here, this is going to be a deferred tax liability. And that is going to give me my total. Now, in B, we're only asked for the deferred tax asset or liability at the end of 2020. So we're specifically looking at this period here. Okay, so our deferred tax asset at the end of 2020 is going to be $10,000. So what we should say here is the deferred tax asset at the end of 2020 is $10,000. Not super clear, and that would definitely get you full marks on an exam. Okay, let's move on to B. So for B, oh, actually we just did B. This is right up there. So now we're moving on to C. So C says prepare a schedule of future taxable and deductible amounts at the end of 2021. So future taxable and deductible amounts at the end of 2021. So above we were asked for 2020, but now we're talking 2021. And remember, this exercise we went through here only has to do with depreciation versus CCA, but we also need to remember to pick up any other reversing differences in the question, because those will also give rise to future taxable or deductible amounts. And it's really important that you recognize the word amount here. It's not asking for the deferred tax asset or the deferred tax liability. It's specifically saying the amount, meaning the gross value before we apply the tax rate. So we've got, so let's create this schedule here. So we're going to run the years across the top. We're going to have our items that we're going to have are CCA, and there's a rent item above that we'll take a better look at. So we've got end of 2021 means we're looking forward. So we're going to have 2022, 2023, 2024, and the remainder. Okay, so for CCA, what's our difference at the end of 2022? We've got this difference here. Again, we're looking for the gross value before we apply the tax rate. And 2023, we've got this difference. 2024, we've got this difference. And then our remainder is this number here, the negative, okay? And then for rent, what do we have going on with rent? So up here it says, on January 2nd, $210,000 was collected in advance for the rental of a building for 3 years. The entire $210,000 was deducted in taxable income, but 2/3 was reported as unearned revenue. So is this going to be a future tax asset or a future tax liability? Well, we're paying the tax for this building in advance. So it means that when it's recorded for accounting purposes, we're going to be able to deduct it for tax purposes. So we're going to, okay, so for the rent, actually, let's just go back there. So is that a deferred tax asset or a deferred tax liability? Well, for accounting purposes, we haven't deducted the entire 210, but for tax purposes, we have. So in the future, when we record revenue in our accounting income, we're going to need to add it back to our taxable income or subtract it from our taxable income because we've already paid tax on it. Therefore, we're not going to tax it again. So this is going to be a future tax asset. Okay, so let's run that through. So we're going to take the rent is going to be, okay, so what do we have for rent? Let's just do a quick calc here. So we've got rent. So the rent was $210,000, right? And we recorded 2/3 not in revenue. So this amount times 2/3 is going to give me 140,000 that's not in revenue, and it's going to be recorded evenly over 2 years. 2 years is going to be this number divided by 2. So 70,000 each year up here. So I'm going to have, it says the entire 210,000 was included in taxable income in 2021, but 2/3 was reported as unearned revenue, and it's for 3 years. So this is going to be recorded over each of the next 2 years. So we're going to have 70,000 here, which is the future deductible amount. Okay, so my total here, which is what I need to run. So I'm going to run sum and here, 140. Okay. So that gets us through C. So now let's look at D. Prepare a schedule of the deferred tax asset and or liability at the end of 2021. This is really the same idea of what we were doing above. So now we're going to put D up here. We're going to put deferred tax asset or liability. So we're going to put the tax rate. And it's 40% for each year. And then we are going to put asset and liability here, just like we did above. So now this amount times, this is actually a liability. So this 2,500 times the 40% is going to give us a future liability of $1,000. And then this amount, which we can deduct in the future between accounting income and taxable income, is going to be a tax asset of 56,000. Okay, so we got that. So now what was the question that we're trying to answer for C? So it says prepare a schedule of the deferred tax asset or deferred tax liability, and this is our schedule right here. So D says, E is calculate the net deferred tax expense or benefit for 2021. Net deferred expense or benefit for 2021. So what we really need to remember here is watch for opening balances. Okay, so remember that income tax has two components. We have our current tax expense, and then we have our deferred tax, and that's what we're talking about here. So deferred tax expense is based on the change in the statement of financial position, deferred tax asset or the deferred tax liability from the beginning of the period to the end of the period. So I'm going to have it deferred. So let's make here, let's say we've got deferred tax asset opening. Okay, so our deferred tax asset at the end of 2021 is going to be right here, this deferred tax asset, 56,000. Now, what's my deferred tax asset at the beginning of 2021? Meaning the opening deferred tax asset. Well, if I look up here, I did have a deferred tax asset. Remember how we had this deferred tax asset at the end of 2020 of 10,000? So let's include that there. So that's my opening balance. So let me send you that. So now my deferred tax, now my deferred tax balance, my deferred tax is going to be the sum of these two, or the change in these two, and because they have different signs, it's going to give me the net. So now I've got 46,000. Now let's look at the deferred liability account, deferred tax liability at the end of 2021. So here I've got up here, I do have a deferred liability of 1,000, right? Now, did I have a deferred tax liability at the beginning of 2021? Well, at the beginning of 2021 or 2020, what do I have here? Well, remember this schedule up here. So right here, I've got 11,000 as my deferred tax liability in 2021 opening. So I do have 11,000 here for my CCA schedule. So now I'm going to have this is my deferred tax asset. This is going to be my deferred tax liability. It's going to be the sum of these two things. Okay. So now my net deferred tax asset liability is going to be okay, let's just go back for a second. I did make an error that I want to correct. So let's ignore this line here. We don't need to pick up that 11,000. So we've got our opening deferred tax asset for 2020 of $10,000, which we've included here. Now our deferred tax liability at the end of 2021 is 1,000. We didn't have a deferred tax liability at the end of at the beginning of 2021, or we just had this amount here at the end of 2021, which is 1,000. So our net deferred tax asset and liability is going to be the net of the asset and the liability balance, which is going to be 45,000. And this is going to be our income statement amount. So now we just need to do our journal entries, which is the very last part of this question. F, prepare the adjusting journal entries to record income tax expense, deferred taxes, and income tax payable. So remember that total income tax expense includes two components. We also have our current tax expense, so let's not forget about that. So we're going to have debit current tax expense, and this is the tax due for the period. This is going to be our pre-tax accounting income. So if we look up at the question, we've got, where is it? Or taxable income, sorry. So we've got, what year are we looking at for 2021? So 2021, we've got 180,000 times the tax rate of 40%. And we're going to have debit, credit, income tax payable for the same amount. Really important that you pick up the right year here for the taxable income that we're given. And then we're going to have our deferred tax entry. So remember that the statement of financial position has to be gross, and it's the net change that goes through the income statement. So we're going to have debit deferred tax asset. We want to increase that account by 46,000. And then we're going to have credit deferred tax benefit. And this is going to be our asset on, or this is going to be our income statement amount, which is going to be this net amount, 45,000. And then we're going to have credit deferred tax liability. And this is also statement of financial position. So let's pick that up, and that's going to be 1,000. So just ignore the signs here. One thing that I actually find really helpful, because the thing that I find confusing about these accounts is that they all have a very similar name. So that's a statement of financial position account. This is our P&L account. So you can see it's the net that went through the P&L. And this is also the statement of financial position. So you can see that we've got the asset of 46,000 on our statement of financial position as an asset. We've got the liability on our statement of financial position as the 1,000. And then the net of the two is what goes through our income statement, and it's called a net tax benefit because it is in an asset position. You can see the asset's a lot bigger than the liability, or else it would be called debit deferred tax expense. So this is almost like a recovery of a deferred tax. This is a positive a credit to the income statement. So we would debit it to have an expense go through. So this is a recovery almost of tax. So it's a contra tax account that's going through our income statement because our asset is larger than our liability. I hope that makes sense. This is a complicated question, but it's a really good illustration of what an exam question could look like.